I'm not sure if anybody's in the restream room. It just got announced just now, but all I'm going to be doing is going over election euphoria gap. I want to go over this. I think it's a big deal and it's been working. So we'll continue to try to do this. So give me 1 second. So the way I'm looking at it, number one, is I look a lot at the markets versus the bond market. So just keep in mind everything did hold support. The SPX did hold support. So that was a big deal in here. Give me 1 second. And so let's go over what we're talking about. So number one, a lot of times into an election, you get the euphoria gap, especially if somebody promises deregulation and tax cuts and all that. So we've been using as a poster child a lot what went on in 1980 with Reaganomics. Now, keep in mind, I was trading around then. So just keep that in mind in there. In the meantime, by the way, if you were listening to me about the ES, yeah, the ES filled the gap. So it filled the election gap finally. So that's one reason the markets are trying to rally. So just keep that in mind in here. The other thing we were talking about the Dow Jones Commodity Index, and it is indeed selling off just a bit, just a bit. Now, I wouldn't say the most amazing thing in the world, but I wanted to show you this so you knew what I was talking about. So a lot of times, markets go up with the election. If it's, like I said, pro-business. One of the most pro-business people was Reagan. You have the Reaganomics. So the markets gapped up when he got elected, but the yields were still going nuts. That's the yields, not the price. So the yields were still going nuts for 18 months. So, and as you see, the yields went down until the COVID thing, and now there's inflation in the system, and you broke a 40-year downtrend in yields, which I think is a big deal. So keep that in mind in there. So what else are we watching then? When you see this, the next thing you're going to want to watch is what happened in 1980. Now, that doesn't mean it's exactly going to do the same thing, but so far it has. So I'll show you what we're talking about. We're talking about the S&P, and by the way, that's your major support in the S&P. The RTY is already there. That's why we like the RTY more. But let's just go in so you know what we're talking about with the S&P back in 1980. I'll show you what we're talking about. So you don't have to look at the moving averages that much, but there is something to look at. And that is, see the purple line? So most funds use a 20, a 50, and a 200 moving averages. Whichever ones work for you is fine, but this is what a lot of funds use. So a lot of times sell-offs stop at the purple line. That's a 200 moving average. Look at that historical perspective that most rallies at least try to kiss it. So I'm not saying you can't keep going up, but usually it's healthy if they go back to it. As you see, the S&P is way above it. So it's above it by like 300. So just keep that in the back of your mind later, not now, later. Now, going back to it in here, I want to show you what we're talking about. So we're going to go into here and we're going to 1980. Like I said, I've been doing this a long time, so I was around for this. And what you're going to see is that the market went up. If you didn't know, you should follow me on StockTwits at Christopher Brecher. And basically, I put these in here. Now, you might say, why would you put that in StockTwits and not just in the Chart Patterns Mastery? Because a lot of the charts I show, they erase in the chat overnight. So this way you have a running thing of them. So I can sit there in front of 56,700 people and humiliate myself as much as possible. But no, all kidding aside, after 5 minutes, you can't delete your post. If you go back to my post, they've been pretty spot on. That's why I have so many subscribers. But just go to that. and it's worked pretty well. So let me copy and paste this so you know what I'm talking about. The whole idea in there is that way you could sort of see some things I might have posted the day before. Not trades. Don't get me wrong, it's not trades. This is just some, charts. That's why they've been right a lot. And that's why StockTwits, out of 5 or 6 million people within StockTwits, I was in the top 10 for old school, like posting content, not bragging, posting content. So just keep that in mind. But getting back to it in there, and I don't brag because I don't show them trades. So just keep that in mind. All right. So go back to 1980. And I want to show you what we're talking about. So here's 1980, and you're going to see the election euphoria gap right here. Right there. Election euphoria. So on the other hand, the bond market was still getting toasted. So I can go and share this. Now, I know I've shared this a lot in here, and you probably already have it, but I'm doing this as like a session you can go back and refer to. Our election euphoria gap. Right there. So, and what happened? You went and filled the gap. In fact, where'd you sell off to? November 1st. If that looks familiar. So let's take this. This is 1980. So I'm going to go and put this down here just in case it doesn't work right. Just in case you don't see all the, on the bottom, the dates. All right, election euphoria gap. So let me copy and paste that for you. Now, keep in mind through all of this, I'm not saying you have to go fill the gap. What I'm saying is it's very similar that the bond market has been going down or the yields going up while everybody is euphoric. The other thing is when you go to now, it's not necessarily that you have to fill it. I just want you to know that. In fact, let me copy and paste this also. It doesn't mean you have to fill it, but the key is so many indexes have that the probability was it was going to fill it. Eventually, I think it goes to 200. But keep in mind, before you think it's plummeting to there, if this stays up here, yeah, the 200 slowly goes like that, and you could kiss it that way. And as you see here, it didn't go to it, got close. But the key in here is that the gap, it's filled the gap. So I want to show you a couple of different iterations. Number one, the Russell is down here. So this is your gap. Now, keep in mind, I've been showing these objectives now for 2 weeks, not just today, not a hindsight thing. This is where the Russell there. The Russell, the Dow Jones transports, the XOU, and the DIA are already at those levels or lower. So don't think you have to just go crazy here, but you did fill the gap. So you did fill the gap. So keep that in mind. So let's go and just copy and paste that for you. That's your first objective, and you hit it. So you hit it. That was great. So keep that in mind. That's fine. So you went and filled that election euphoria gap. Like I said, the other indexes have overshot, and that's why I actually like the Russell more. And the reason I like the Russell more is it's overshot and gone to the 200. So somebody asked me a great question. Well, what Russell stocks do you like? Unfortunately, most of my watch are just sitting there. They're not doing a lot. But there's your election euphoria gap, and it's already filled it. And the point is that that was your objective for the S&P at the minimum. So let's just show you this. And then gets the big kahuna, and that's the NASDAQ. The NASDAQ's not close to filling it. Keep in mind, the NASDAQ did go to the 200 back in early August, late July. This has not filled the election euphoria gap. Maybe it doesn't. But usually what happens is their earnings are bad enough in the NASDAQ stocks to fill the gap. That doesn't not mean to bet on that. But I just want to show you. There. So just that, election euphoria gap. So I just want you to know where they are. Now, the point in there does not mean to go and blindly buy it if it fills the gap, especially when other indexes have overshot it. But what it does mean is that you can start looking for reversal patterns. You can start looking for reversal patterns, but you don't have them yet. So in that area. So the ES might have a little reversal pattern. You see it, little candle. So you can go and take that on a 5-minute. There. You see it stop going down. I'm not trying to be glib about that. I'm just saying it's trying to form something like this. We call that a Stewie pattern. If you highlight it, well, it's being a little ambitious, but like that, a Stewie pattern. Sort of, if you highlight it, it looks like Stewie from Family Guy, but it's basically just an inverse head and shoulders. And as you see, it's sort of working. So this could definitely go to unchanged because it's filled the gap and it becomes a self-fulfilling prophecy. So, definitely keep that in mind. In the long run, you still want to see the bonds up a lot. Usually what happens at a bottom is that the bonds lead to the upside. The stock market has a mind of its own on the downside. It happened in July. But the first objective was that gap, and it filled the gap. So not the 24-hour. We're talking about the SPX, and it indeed filled the gap. If you look at a lot of the charts I've put up, the one I showed you with support and resistance, you hit your first line of support. So if you go into here, there's your first line of support. Forget about that. I'm talking about a daily. You could even do an hourly if you want. There you go. So this zone becomes support. But the whole key was that this needed to fill the gap before it could go back up. The big kahuna now is, like I said, big kahuna, but that's old phrase. Is the NASDAQ going to fill that? That's number one. Number two is, are these going to overshoot the gap like the Russell has? So here, let me take this off. Intraday, I use an ATR trailing stop. That's about it. But there you go. You see the election euphoria gap. So let's put that in there for you. So there's your election gap. Like I said, the big deal, though, is other indexes have overshot. So that's why I liked other stocks within the Russell, and it hasn't worked yet. Probably will with the transports and all that. But just keep that in mind, what we're watching in there. So we're definitely watching the gap, and it filled it. The problem now is you have the overhead resistance right here. There are a lot of people that think that's a breakdown or a Brecher ledge, which is after a sell-off, you get a horizontal trend line like this that you can draw. The problem is it's a horizontal trend line at support. This was a much better Brecher ledge. You sold off, you consolidated in a horizontal way, and then you really didn't have much support. This time you have a lot of support. That's why it stopped. The big key now is it going to stop a resistance? So we'll see by the end of the day. I'll be monitoring this all day in the Chart Patterns Mastery room. But the key in here is you did fill that gap. No doubt. I mean, and we'll see if it matters. Now, just keep in mind another thing. I showed you the election euphoria gap. I showed you that you filled the gap. But there's another thing a lot of people miss. And I'm very visual when it comes to charts. I want everybody to learn this. I want everybody to make money at this. And I think the more visual, the better. So the other thing I want to show you in here was what happened in 1980 after it filled the gap. Remember, November 1st. Just keep that in the back of your mind, November 1st. Keep in mind the price support. Now what we're going to do is erase all this. We're going to go back to 1980. Just keep in mind, if the bond market is in a bear market like it was back here, or the yield's staying up, and to me, the bond market's in a bear market now, or the yield's in a bull market, then to me, the broad market is going to have a tough time making new highs. But I'll show you a big but. Family channel. I mean, big but when it comes to the market. So I'll show you. We'll go back here. And I want you to see what happened. So I know Adam and Max are all over this. A lot of times after it tests the low, remember that's November 1st, 1980. Right there. Tested the low. You had this spectacular rally. Why? Guess what? In a Republican administration coming in, a lot of times you get an inauguration short squeeze. Believe it or not, I've done this a long time, so I see this kind of stuff. So here you go. That's a ugly short squeeze if you're bearish. Great if you're bullish, obviously. But it did test support. It did have a reversal candle. And then you had a spectacular rally that stopped close to all-time highs. Keep in mind, this wiped off a lot of bearishness. Everybody thought the sell-off was done. Why didn't I? Because the bond market was still in a bear market. So this move right here, that was it. For 18 months, the market sold off. It just didn't sell straight off. Very rare to ever have a crash. That was 87. 89 had a mini one. You've had little ones, but this is just slow death. Slow death all the way down. The rallies were a lot more sharp than the sell-offs. That's typical. All these ugly rallies. So the key for me is definitely you could have that short squeeze. But the problem is that if the bond market doesn't start rallying or the yields plummet, then this is probably going to be short-lived. That's how I look at it. So when do you really, really find the bear market? It's when that top took months to develop because the momentum was up. It's like a super tanker. Abby Joseph Cohen, famous analyst, used to liken the market to a super tanker. The inertia, it's very hard for a lot of mass to stop going up and then turn the other way, like a ship. So the super tanker. So the key is this took a long time. You finally got the break. That break went down by this amount. It was symmetrical. And then you got the sharp rally to the neckline. That's what I expect unless I see this stop doing this. It's very similar to what happened in 1980. That's a real dramatic sell-off. 60 points, almost 70 points. So unless that starts rallying, I think you have to sell every rally in the indexes. But once it filled the gap, I wouldn't do anything in here at the moment. I'm just saying if that doesn't recover, I can't chase rallies. That's all I'm saying. I can't chase rallies. So that's where I am. So just keep that in mind in there. Now, I'll show you some other stuff because I have a couple of minutes left. So Number one, when I'm talking about the S&P filling the gap, the probability though of it then going all the way back up here goes down. If the bond market was the thing that made it go down in the first place, doesn't go up. So I want to show you this side by side so you sort of get a perspective. So this is the bond market on the right. Just want to show you on the right. We're taking the long bond. You could take the note, you could take all this, but since I've been in the business, everybody keys off the 30-year. So this is what you look for that can make your career, is that trend line. I don't trade bond futures. If I did, though, I'd be all over shorting the futures here on that break. So what you're doing is you're looking for multiple points of contact. See that? And then there was no support till here, and that's where it stopped. But getting back to it, what you're going to notice in here is that the bond market hasn't bounced whatsoever. But what happened in July? In July, the stock market went down because of Japanese fears of the yen and the carry trade and all that. So what happened is that's what happened. This got destroyed. But in the meantime, the bond market diverged positively and went straight up. So that's what I'm saying. The bond market rallied and the stock market had a mind of its own. That created positive divergence. So that gave you enough fuel for a good rally. The problem this time is the bond market hasn't bounced at all. You don't have any positive divergence yet. So it's extremely hard for me to chase rallies. That's all I'm saying. So even though it's filled the gap, I would have liked to see this fill the gap, overshoot, and have the bond market all the way up here. Then I'd be more comfortable about buying everything. So just want to make that clear of how I'm doing that. So to me, the big deal, and this is the other thing I think you need to watch. The other big deal, watch the Dow Jones Commodity Index. I know there are a number now talking about it, and I was first. Just go back to stock twitch. You could see on how long I've been harping about that. Bonds hate inflation. Why did 1980 have a bear market? Because of inflation. So just keep that in mind. In fact, the inflation actually started in 1974 with the oil crisis. It takes forever to tighten policy to calm inflation. Just keep that in mind. So now you have inflation in the pipeline because of COVID. It's going to take a while. So this could, to me, could have another leg up. But getting back to it in here, what I wanted to show you was this. Here's the Dow Jones Commodity Index. Like I said, a lot are now quoting it. A lot now are quoting it. If you go back to stock twits, I showed my crazy idea for 2025 was that breaking up and the bond market still going down. They correlate beautifully. As you see, bond market selling off, this going up. This selling off here corresponded to a little bond rally here. So it works. So the other thing, what's in the Dow Jones Commodity Index? Well, one of the biggest proponents is oil. Oil broke up. See a little triangle right here. See that? And before you say, oh, you're just a commentator and you're just showing it in hindsight, just go back to the trusty stock twits and go check in here. I post a lot in there, by the way. There, that was my crazy idea for 25 from 70. Yep, it's posted way back here. I'm not sure how far back I can go. Let's see. See that? January 6th. So it's there. It's under my crazy ideas. Crazy ideas. Let's see where it is. Well, it's in here. So all I know is it's in there. There you go. There it is. December 25th. Another crazy idea. This makes no logical sense, but this CL triangle breaks to the upside and this goes to 100. So just realize 70. And then go look and where it is now, 79. So stock twitch comes in handy. That's why we were long Exxon and CVX. But the key is the higher this goes, the higher the Dow Jones Commodity Index goes, and the less likely this goes up. If this doesn't go up, and that's what led the broad market down, then the broad market's going to have a tough time having a massive rally. So just want to let you know, commodities influencing bonds and the bonds influencing the equities. And that's what we do. So just, keep that in mind. That's how we trade. So the next thing you might want to know is, well, could the market go up today? Yeah, it could the Russell is acting much better. Remember, the Russell has overshot. If the Russell can get going, the first thing, if that Dow Jones Commodity Index starts selling off, then the bond market can rally, which would probably make the Russell successfully test November 1st, which would make these rally. So just keep that in mind. That's what we're watching in here. Like I said, by the way, DJCI on TradingView, it's a good question, Don. I just use DBA and DBC and sort of combine them. So I haven't seen the agriculture work as well as the DBC ETF. There, and that's no bargain. It's a great question. How about DJCI? Well, the problem is you'll see. They have sugar, nickel, cocoa. I don't know where it is. I've been looking. On the other hand, I wish it had more than 10. So I tried DJCI. I've tried them all. So I'm sure there are more of them and I should be able to find it, but I haven't found it yet. So I still haven't found what I'm looking for in there. So I would just, really probably the best way is just use crude oil because that's a big component. So when you see the crude oil, that looks a lot like this. Let's put them next to each other. Maybe that'll help you out. Not perfect because this is a basket, but at least that gives you the gist of it. So, that's how I do it. Probably crude oil. On the right, like I said, the commodities have had somewhat of a sell-off, so it's not perfect. So, I'll Don, when you're back in the room, I'll go and I'll actually contact TradingView and ask them if that helps. So, in there, I hope that helps. They're friends of mine. I was there when they first started, so I was asked to invest in them. So sure, I'll be happy to ask them. But that's what we mean by the election gap. And like I said, it's not the Russell I'm bearish on. It's not the ES I'm bearish on. I'm actually I'm on the fence with the NQ. The NQ should fill it. But what I've seen in the past is what happens is the NQ doesn't do a thing until all these companies report, and then it fills the gap. So that's what I'll be watching now. I think the biggest deal for today, if you're a day trader, remember we talked about the YM going up, the transports going up because they hit November 1st levels, the Russell going up. So sure, the ES could go up here because the things that made it go down other than bonds are rallying. So, keep that in mind. So I'll definitely look up the other for you. But when you see this many of my main list up, this is not the day to short the ES in the hole. which I mean shorting on the, like when it's oversold at support. So you'll see URI up, Caterpillar up. Yeah, those are sort of infrastructure plays. So take care and thanks for being with me.